With many companies taking 2021 as a pretty good time to load up on cheap debt, is the tide turning as rates climb? Should investors be wary of what this could mean for over-leveraged businesses? To help us get a sense of the risk out there, Frank Daniele from MA Financial, joins us now. Welcome.
Hi,
nice
Nadine.
To see you.
Yes, good to see you.
Yeah, that's the thing, isn't it? It was, times were great, debt was cheap, and there was that sense, why wouldn't you take on more debt as a company when interest rates were, at these emergency low levels? Why not?
Well, we certainly did see that, Nadine. In fact, I think last year was the second best year for debt capital market issuance on record. So we saw a lot of companies take advantage of cheap money and easy money and the sort of large amounts of liquidity that were in the financial system. I think there was probably a tale of two cities in that area between the behaviours that were happening in the bond market and in the corporate loan market separately. So in the bond market, what we saw was that investors, and this is almost hard to believe, but last year people weren't talking about rising rates. They were talking about a lower for longer interest rate world. And so what investors in the bond market did was to stretch on duration, meaning buy longer term dated bonds to try and get a return pickup, often fixed rate bonds. And those investors are really, really hurting now because I think the bond market has had its worst 12 months since March of 1980. But on the corporate loan side, we saw a bit of a different dynamic, which this was a fixed rate asset, a floating rate asset class, And so we saw with a lot of money in that space, very, very high leverage go into transactions, weak protections for lenders, and finally, increased use of pro forma earnings to sell those deals. So I think it's actually that latter part, the use of pro forma earnings, which could be the canary in the coal mine for corporate debt this cycle.
Okay, so what happens then in this cycle? I mean, is it just too crude to say all of those over-leveraged companies that got a lot of that funding based on the pro forma earnings are going to, default?
I think it is too crude to say that, Nadine. In fact, just because a company has high leverage and interest rates go up doesn't mean that a company will default. In fact, interest rates are coming off such a low base that it's probably not debt service necessarily that is going to be the problem. I think the challenge could be for those companies where there's a fundamental business issue or where they're a cyclical business, they don't have pricing power, so they can't pass on higher input costs from supply chain pressures or from wage inflation to their customers, and they've got significant amounts of leverage. And I mentioned earlier this concept of increased use of pro forma earnings to sell deals. I think what happens in this environment is that investors gravitate back towards true free cash flow. And the question will be, does this business actually generate true free cash flow that can support it resiliently through this cycle that we're going into, or have they been coming up with some creative accounting to sell those debt deals? And I think unfortunately we did see quite a lot of interesting accounting used in these pro forma earnings to sell these deals.
Yeah, very politically correct there. So essentially what this is then, and what this becomes for equity investors, it becomes a headwind to profitability and to earnings growth going forward.
That's right, and that's right. And I think that we probably haven't seen the market price in the impact to corporate earnings that could occur from this cycle. They might have priced in the fact that there are simply higher interest rates because that's an easy calculation. But is the company exposed to higher amounts of discretionary consumer spend, for example? How does that flow through their earnings base? And a changed earnings base with high leverage is a difficult mix.
So if I think about certain cohorts of investors that might be particularly exposed to some of the risks that we're now seeing in terms of corporate debt as interest rates rise.
Sure.
I can think that there was a lot of sort of high net worth, a lot of family office types that were looking for the higher yields on offer through some of this, private equity backed, private investing type theme. Do you think that there could be some pain felt there?
There could be. And what happens in times when interest rates are low is that people tend to stretch for yield. And that means take a little bit too much risk in order to earn. Go up the risk curve. And I think that in the area that you mentioned, so leveraged loans or loans to private equity backed companies, the balance of power was clearly in the favor of the private equity firm. There was a lot of money flowing into the space. And when that happens, you tend to have, again, lower protection for lenders and higher leverage in transactions, which means investors perhaps aren't getting properly compensated for the risk they're taking. I think that it has been said that the best bargains are at the auctions that no one shows up to. And during this time, it was the area of private credit, which we like to call asset-backed lending, which didn't get a lot of love and didn't get a lot of attention, where I think the best opportunities are and still remain. But for those in the sort of exposed to the corporate debt space, I think you'll see a bit of a reset there.
Okay, look, talking about sort of the broader thematic, last week, Volt Banking closed its doors, essentially returned funds back to its customers. So that's in the fintech space. It was finding it difficult to raise capital in this environment to essentially keep going. Is that sort of a canary in the coal mine situation as well, you think?
Yeah, look, it's sad to see that, because you want to see innovation in the banking sector. It's been an oligopolistic market for many years, and we do want to see more diversity in that space. I think that what has happened in fintech is that particularly venture capital investors and growth equity oriented investors have been excited by what they call a large TAM, a big total addressable market. And finance is one of the biggest industries in the world, so it's one of the biggest TAMs out there, and people get really excited about that. The challenge in this space is that it's a really capital intensive business, and it's a business in which you need to have very optimal access to funding in order to compete with some very large institutions. And I think that unfortunately a lot of the online lenders, where they're making large losses focused on the tech side of the business, not the actual finance and lending side of the business, will continue to see pain. But at some point there'll be great opportunities, I think, in that market to identify winners and back companies that are low. But it doesn't feel like we're quite there at the low yet. Okay. But I'd watch the space.
Yeah, well, do you think, though, that we'll see more of these sort of smaller fintechs just being bought up by the big players regardless?
It could be. And in fact, if they've developed some really interesting technology, but perhaps they haven't got the actual funding and capital side of the business right, there might be a bigger player, whether a bank, a non-bank, who could actually look at that company as a takeover target for that reason. And perhaps we'll see that across the sector. Particularly when we start to see some large banks trying to invest in their own technology platforms. You've seen CBA with their product they call Unloan, the ability to do quick and efficient mortgages digitally. And we're starting to see even technology companies like Apple with Apple Pay Later come into the market. So there might be takeover opportunities there, or alternatively opportunities to buy companies at the bottom. Well, but as I said, I don't think we're quite there yet.